Hi, this is Monty Agarwal for Uncommon Wisdom Daily. Global central banks have managed to gloss over the problems for the time being due to their reckless money printing. By pumping more than €1 trillion into financial institutions, the European central banks made the markets forget about Eurozone bond auctions for quite a while. European banks used much of this cash to buy government bonds, which is exactly what the ECB wanted them to do. But the party is about to come to an end. Wage pressure is building in Germany, complicating the ECB's monetary task. And tension among central bank members is also building. Two German policymakers, Axel Weber and Jürgen Stark, quit in protest of the bond buying program. And if the opposition candidate, François Hollande, wins the French presidential elections, they could reach the boiling point very quickly, and the euro could take a serious tumble. Meanwhile, the European bond market will get a big test this week when Spain issues debt maturing in 2014 and 2022. If the auction disappoints, the spread between Spanish and German 10-year bonds could rise to 4.5%. The yield on Spanish 10-year government bonds is already around 6% amid continued fears about the health of Europe's fourth largest economy. The cost of insuring Spain's debt also spiked to a record above 5.1% according to credit market analysis. That means it costs €511,500 to insure €10 million of Spanish government debt annually in a 5-year period. In other words, analysts and investors are increasingly concerned about Spain's economy and banking system, despite the recent cash injection by the ECB and tough new austerity measures. But it's not just Spain. Italian 10-year government bonds were trading above 5.6% earlier this week, while comparable Portuguese bonds were up above 12.6%. And Irish benchmark yields are now the closest they have been to Spain's since August of 2010. After a positive start to the year, it's troubling to see the market sentiment turn so sharply. The return of the Eurozone debt crisis is being compounded by a poor US jobs report that we saw recently and a slowing Chinese economy. As a result, a lot of investors who missed the first quarter rally and jumped into the markets at the start of April have found themselves wrong-footed again. My Rapid Growth Portfolio subscribers, however, are well positioned in a double-barrel play on Europe and US bonds that's designed to hold up and profit in these conditions. This investment is part of the unique long-short hedge fund approach I use, which is ideal for the current market environment. I'm Monty Agarwal for Uncommon Wisdom Daily, and thank you for watching.